right, welcome everyone. We're glad to have you here. We'll probably go ahead and get started in just another minute or so. I'm Kate Westfall. I'm COO of Global Ag Investing, and we have been running this webinar series since we all got shoved indoors with the pandemic, and they've been really popular and I think really effective. And we're absolutely thrilled to have you and Friday here from Kilter Rural in Australia. Got up early for us, so we're grateful. And we're going to learn a little bit today about investing in water assets. And I hope that some of you got to see his sort of pre-videos as a little primer for the session, but I'm sure we'll get an incredible amount of great information here. So I'll be taking the Q&A as we move through. I will start asking only once the presentation is done, so you can hold your questions to see if they might be addressed in Ewan's presentation, or you can go ahead and log them in and I'll try to get to as many as possible at the end. And with that, I am going to hand it over to you, Ewan. Thanks so much.
Thanks very much, Kate, and welcome everybody. I guess it's good evening for most, or good afternoon in the US. It's good morning from a chilly sort of northeast Victoria here in Australia. So my name's Ewan Friday. I'm the Chief Investment Officer at Kilter Rural, where I've been now for, well, it's been over a dozen years. Yeah, actually more than that. Just a little intro to Kilter Rural. We're an industry leader in impact investments. So we've been managing wholesale and institutional capital in Australia since 2006. Today we have just a bit over $500 million in Aussie dollars under management in farmland and water assets. We manage some pretty significant farms in northern Victoria, the largest producer of processing tomatoes in the country, as well as irrigated organic cereals. But by far the largest proportion by value of the assets we manage are water assets across one mandate and 3 funds. It's north of 400 million in water assets under management. We're pretty pleased and proud last year to receive recognition as Australia's Impact Asset Manager of the Year, really based on a track record of what we've been doing right from the outset, both in the land and water space. Part of what we've done in the water space was the founding of the world's first water impact investment fund with the Nature Conservancy back in 2015, and I'll cover that in a bit more detail later in the presentation. So in terms of what I'd like to get through today, it's really to provide an overview of how this asset came into being and became something that you could invest in, the markets in which we invest, how those markets performed historically, what forces we see at work going forward, and our approach to generating returns for investor clients in this space, as well as introducing the couple of open strategies that we have here. Look, as I said, I've been doing this for over a dozen years. I'm still fascinated by it. It's an amazing commodity. There's nothing really like it. It's sort of unlike any other commodity that can respond to a price signal. Water doesn't. It responds to things like climate. It's irreplaceable, and it's the limiting factor of production in Australia and pretty much anywhere else in agriculture. So it's got a whole heap of really interesting characteristics. Necessarily, there's a lot of detail in this space and I could talk for hours, but I want to whip through this quite quickly to provide as much opportunity as I can for Q&A subsequently. So it's really important at the outset here to understand what we're talking about. There's some definitions or words I'll use throughout that are really important to understand, and that is firstly, a water entitlement. A water entitlement is the investable asset. It's a permanent right to receive and participate in the water resources within a given system. And in the context of what we're talking about here, that's the water resources within a given storage or dam. It's permanent and it has all the same sort of features as a land title. It can be bought, sold, leased, mortgaged, divided or amalgamated. And the water allocation is the volume of water that's allocated against a water entitlement in a given period. In that period is generally a year. Water allocations are represented as a percentage of the underlying entitlement. So for example, in the current irrigation year in the markets in which we operate. If you owned a Goulburn entitlement, to date this year you've received an 80% allocation. And that year runs from the 1st of July through to 30 June. So they're the sort of underlying concepts that underpin everything I'm going to talk about. Thought it'd be worthwhile just giving a little bit of history as to how these assets came into being and such that we can invest in them today. Really, it was an economic development initiative that started in the Depression, but really accelerated post-war to lift Australia's agricultural productive capacity by building dams and irrigation infrastructure, and to open up irrigation districts to promote the development of irrigated agriculture. And what they did was went out and built the dams, and then they constructed water delivery infrastructure into irrigation districts, and they went out and assessed soil types and land capabilities, and they'd say for in one district, yeah, this is perfect country for running dairies, so we'll give you a water entitlement of 5 megalitres to the hectare, and we'll insert that entitlement onto your land title, so you'll have it permanently. And over here we say, well, this is great country for growing fruit trees, for example. We'll give you a water entitlement of 10 megalitres to the hectare, and we'll insert that on your land title. And that all progressed, and the production increased. But during the sort of 70s and 80s, they realised that they were having some really big problems in this space, because the system was pretty much use it or lose it, and it promoted people to basically use water unwisely and waste it, and it was generating significant issues like salinity. And there was a recognition that they'd over-allocated this resource. So in 1993, the state and federal governments got together with the National Water Initiative, which undertook to do a number of things, but the first thing it did was put a cap on issuing any more water entitlement. It also set about creating markets to enable this scarce resource to get to its highest and best use. That developed reasonably quickly in the allocation space, but it took a while to get all of the infrastructure in place to facilitate it for water entitlement. And that culminated here in 2007 with a process that was called unbundling. And that unbundling pulled apart the water element on the land title and created a water entitlement and a land title. Both have the same features, in terms of being transferable, mortgageable, leaseable, etc. And they're both recorded in the same place, in the Land Titles Office. But what it meant was that the water could be sold separate to the land, and hence that created the opportunity for this asset to be invested in its own right. And we pretty shortly after that approached our institutional investor client at the time, Big Super, and pitched to them a project to invest in water entitlements exclusively, and we got that up and running in 2008. So the markets in which we invest are in the Southern Murray-Darling Basin exclusively at the moment. And as I described, that sort of economic development initiative took place up here in the Eastern Ranges in the building of 5 major dams, and then the creation of all of these irrigation districts down here. What's really interesting about this whole area, which is about the size of Germany, is that all of these rivers run into the Murray. And that enabled the development of a water trading system across this huge geographic area, because water could be, one river could pick up the downstream delivery obligations of the other. It means, for example, we've traded water out of the Goulburn and up here into the Murrumbidgee, because when you do that, the Goulburn picks up the downstream delivery obligations. Anyway, it's a huge area. It's got a great diversity of agricultural enterprises across it, and it spans a huge geographic area. So that's how we'd sort of pretty much come to, it's pretty easy to make the case that it is the world's most sophisticated water market. Now, in this market today, it's valued at about $25 billion. The single largest owner of water in this space are the Commonwealth and state governments, at about 26%. But individually, it's irrigators who own the greatest proportion of it. We estimate that about 7% of it is owned by investors like our clients. Since that unbundling occurred and records became available, we've been able to build an index that tracks the performance of the market as a whole. It's constructed just like any other index, value weighted by all of the entitlement classes on issue. and we generate income by assuming that the water that's received is sold at the market price at the time. Anyway, so we can create that index and compare that to other asset classes. We can see that over this period since 2007, it's pretty much outperformed all of the other major classes that you could think of in the Aussie market anyway. Equities, listed property, gold, bonds. It has delivered a reward for risk superior to everything except bonds. And interestingly, and not too unsurprisingly, its returns are very much uncorrelated to those other asset classes. And that makes sense because its returns are driven by other factors in the main. So you can think of the allocation income that you get on an entitlement as the rental yield. And that allocation income is really a product of the allocation percentage in any given year and the allocation price. So that yield is, as I say, you can think of it as the rental, and the capitalisation of future rentals then can be, that is the driver of entitlement values. So if allocation price on average goes up, then so you would expect the value of entitlements. In any given year, the major determinant of allocation price is availability. That is how much water is in the system as a whole. And you can plot what the allocation price will be based on the volume of water that's available in the system in any given year. And that's what we call an allocation price curve. And what we're seeing is that that allocation price curve is shifting and it's changing shape. It's shifting because of an implementation of a thing called the Murray-Darling Basin Plan, and that's returning water to the environment, and I'll talk about it in a minute, but what it means is that for any given total volume of water in the system, there's less available to farmers, and that's causing a shift in this curve. At the same time, we're seeing a change in the demand dynamic in the system. It's quite pronounced, and it's a shift towards inelastic demand to an expansion in perennial horticulture crops. And that means in times of scarcity, this price curve gets much steeper because of the behaviour of the owners of these crops. And I'll talk about that further as we progress. So firstly, we've got this Murray-Darling Basin Plan. It was legislated in 2012. To date, it's recovered 25% by volume of the water that was available to farmers and repurposed it to the environment. And it targets a further 6% reduction by 2024. So it's pretty material in terms of its impact on the market and water availability for farming. At the same time, there's a really strong climate change signature at work in this part of the world. This is work that we've undertaken to track rainfall in the catchments. It measures winter and summer rainfall at the dam walls of the major catchments in the Southern Murray-Darling Basin. What it shows is that since 1974, we've had on average a 26% reduction in winter rainfall. That's really important because it's winter rainfall that generates the inflows. You need to get catchments saturated so that then subsequent rainfall runs into rivers. Those rivers run into dams, and you fill up storages. With that reduction in winter rainfall, you can see a 1% reduction causing like a 2 to 3% reduction in inflows. And in fact, that's exactly what we've seen happen. This chart's produced by the Murray-Darling Basin Authority, and it tracks inflows into the Murray system right back into the 19th century, back into 1892. This dark black line here is the average inflows over that entire data set. It's about 9,000 gigalitres a year. What we've seen though is over the last 30 years, average inflows have dropped by about 19% compared to that long-term average. And over the last 20 years, it's down by more than 35%. Back in 2019, the inflows were down by 69%. It was a drought, but what's really important are these step changes. So we're seeing a real change in the water availability, and that's going to continue into the future. So the key metric when considering water, its valuation and where it's going to go is the gross margin per megalitre that a given enterprise or industry can generate by using the water. And this chart represents analysis that we've undertaken to look at the range of gross margins per megalitre that different water using industries are able to generate. And you can see up at the top of this, the highest margin industries at the moment are table grapes and citrus. They've benefited enormously from free trade agreements that have been entered into in the last half dozen years or so with countries China, Korea, Japan. That's opened up export opportunities and really improved the profitability of these industries. Almonds is significant because of its expansion. I'll talk about that in a minute. And these enterprises and industries are displacing what were previously the major users of water in the Southern Basin. Dairy in particular, you know, when we started working in this space back in 2007-8, was by far and away the largest water abuser in the Southern Basin. But it's, you know, contracted significantly whilst these other industries up here have expanded. And what we've seen, as I said, you know, is this large-scale expansion of perennial horticulture, and almonds is the standout. You know, in this century, the areas planted to almonds have grown by more than 12-fold. And there's been really two phases, one during the sort of first decade, and then over the last 4 or 5 years, there's been this significant increase here. And the thing about almonds, you know, this sort of 10,000 hectare increase in almonds here, the thing about almonds is that they're a pretty thirsty crop. And they sort of go from using about 3 megalitres per hectare of water at planting up to over 15 at maturity, you know, in 7 or 8 years. So what that enables us to do here is understand, you know, what the pipeline of demand from these crops is going to be based on what's in the ground at the moment. And we also understand that there's going to be additional plantings, but even without any additional plantings, there's sort of 100 gigalitres or more of additional demand to come from the crops that are already in the ground as they mature. And the thing about almonds and all of these other perennial crops is that the owners of these crops make decisions in a different way to the operators of an annual crop. An annual crop can make a decision about whether they're going to grow their crop based on the prevailing water allocation price. And say, for example, if you're a dairy farmer and the water price is at $400 a megalitre and you own some water, you're far better off just to sell your water and buy the feed in. Alternatively, you know, if you're a cotton grower and water's at $500, well, and you don't have water, you're just not going to buy that water and grow a crop. But an almond owner, regardless really of what the allocation price is in any given year, they need to buy the water to protect the capital value of their crop. And they're expensive to put in. It's like $60,000 a hectare. So they're really incentivised, even in periods when it's really dry and water allocation prices are high, to buy that water and support their crop. So what we're seeing is the combination of those two factors playing a really important role. And that is sort of demonstrated in this chart by looking at the percentage of the total water availability that's used by these high value crops. And we can see that back in 2008, the percentage of the total water availability on an average year, and this average we're looking at here is the average water availability from 2001 through to 2019, but the average water use from these crops is about, you know, 13%. Based on the projections that we know are already locked in by FY28, that's going to get up to over 40%. So yeah, well, that's okay. But in reality, as you would have seen from the inflows chart, there's not much, you know, there's no such thing really as an average year. We get wet years and we get very dry years. What's important to look at is what happens if we get a repeat of a very dry year. Well, if we get a repeat of a very dry year, we find that once we get out here to like 2028, these crops are going to demand more water than is available in the entire system. And they're going to be incentivized to pay a lot to keep their orchards alive. And this chart assumes that these crops are able to access all of the water in the Southern Murray-Darling Basin, that is, out of all of the valleys. But in fact, they won't be able to do that. These crops are sort of concentrated in what's known as the Lower Murray, and there will be trade restrictions out of other parts of the system, out of the Murrumbidgee and out of the Goulburn. So there'll be mostly reliant on the water that they can get in the Lower Murray in those entitlements and the portion of water that can be traded in. And we can see that, so that the percentage of the water that they would need to access of what's available in that part of the system is going to be well over 100%. So we can imagine that in those scenarios, the prices that they're prepared to pay for water allocation are going to be a lot higher than what we've seen to date. But what we have seen to date is some pretty pronounced changes in behaviour in the market. As I said before, water availability is the primary determinant of allocation price. And that's what this chart's showing. It's showing in the bars here water availability across these different seasons up to the current season we're in here, FY20. And as water availability goes down, allocation price goes up. As water availability goes up, allocation price goes down. And similarly, this drying trend here and allocation price go up. But what's really interesting is the fact that, the last time it was really dry was back in 2016. We had prices in the allocation market about 200, 250. By 2019, there's just a little bit less water availability, but prices had almost doubled to nearly $500. And you get ahead of FY20, and you see a situation where 30% down, but a sort of 300% increase in price. And what's causing this is this significant increase in inelastic demand. And that's, goes back to this curve I was talking about here. So we're seeing that this price curve has shifted and it's getting a lot steeper. And so as we expect to see more years of increased scarcity being down this end of the scale and the increase in demand from perennial horticulture, we expect to see this curve get steeper and allocation prices on average increase. So that's what we're seeing going on in the markets. There are good reasons for the prices we've seen and the appreciation that's been achieved both in allocation prices and entitlement prices. Kilter Rule's approach to generating returns in this space is it's sort of pretty much the same as what we'd pitched to Vic Super back in 2008. It's sort of around long-term sustainable returns by acquiring a portfolio of quality water entitlements and then generating and distributing water products to a client base of irrigators. In targeting water entitlements, we look at utility. We think about what's going to be the drivers of that particular entitlement class going forward. We utilise our networks to originate deal flow. And in fact, of the total portfolio of water that we manage, around about 40% of it we've acquired through direct purchase and leaseback transactions with farmers, where we've entered into arrangements that have enabled them to unlock the equity in their water entitlement portfolio. And we generate income through a range of products, leases in the main, and that's why it sort of looks like a real estate investment trust, but also some other products that have developed that help farmers manage risk, things like forwards and spot sales. And so that's really the investment approach that we apply across all of our investment vehicles. Our open strategies, we've got a Kilter Water Fund, which I'll just touch on. It launched in 2014. It's done annualised returns since inception of just under 17%, virtually a zero correlation to equities. What I want to talk about in a little bit more detail today, though, is the Balanced Water Fund. Given the topic of today, investing in water for impact, I just want to sort of showcase this product. We launched this back in 2015 with the Nature Conservancy, target of delivering commercial returns competitive with any other water fund in the market. It targets the support of agriculture through the deployment of lease products and also the delivery of measurable impact through the provision of water to endangered wetlands. And we see this as a powerful exemplar of an alternative way to approach management of water assets in this part of the world. The magic of the fund, if you like, is the way it goes about making water donations. And this really relies on the premise in Australia that the wetlands have coped to deal with droughts and floods, but they haven't coped to deal with not getting a drink when it's wet. the water and river systems in Australia are highly variable. And in fact, I was reading something the other day that pointed out that if you look at systems like the Murray, it's about 10 times more variable in its natural flows than major river systems in North America or Europe. And that meant that, over the course of its evolution, wetlands got used to getting a drink when it flooded and dried out during droughts. But now that we've built the dams and the levees, these wetlands often don't get a drink even when it's wet. And that's when they need it most. So the way that the fund works is it makes a higher donation to the environment in wet periods, up to 40% of the water from the portfolio. And at that time is when the allocation price is low, so the opportunity cost is low. And in dry periods, when farmers need most of the water because they're not getting water out of the sky and they get all of their water requirements from the channel, it makes a much lower donation to the environment of only 10%. So that's the sort of underlying premise that's hardwired into the constitution of the fund. The fund is structured so that we at Kilter are charged with optimising the financial outcomes, and the Nature Conservancy, who is our partner in launching this fund, are responsible for optimising the environmental outcomes. This is just one example of one of the environmental waterings that's taken place since inception. There are rigorous planning and scientific review of reporting of all of the watering that is undertaken, and those reports are available to unit holders. TNC just published some summary reports on impact delivered in FY19 and cumulative impact that's been delivered to date. And that would be available to any of you if you'd like to sort of get in touch. We're happy to make those reports available. So that's how it works in terms of delivering environmental outcomes. In terms of its performance, we're really proud of what it's achieved since inception. It's just sitting at a bit under 19% annualised returns. Again, very low levels of correlation. We've grown it out to about 70 million in assets under management today. The systems are proven, the structures are proven, its capacity to deliver environmental impact proven. And so we're really keen to grow it out and continue the good work. We see there's opportunity to scale this up to over 200 million over the next sort of 12, 24 months. And we'd really like to get on with doing that. We think it's got a lot more value to add, both in terms of impact as well as in terms of servicing the needs of investors. So that's a bit of an insight to the Balanced Water Fund. In conclusion, I just want to sort of touch on a few points. We see that these assets represent a really secure investment opportunity. They're supported by strong property rights. They're really akin to real estate. As a proxy for agriculture, they provide a really strong inflationary hedge. And they're a really interesting way to think about getting access to an agricultural exposure. You can do it in water without being exposed to all of those operational risks that you encounter when you're trying to run farms. And you can do it in a way that gives you diversity that's much harder to achieve, if you're out buying property. We can, put water into an olive business, an almond business, a dairy, a cotton enterprise. It provides that diversity of exposure. Its historic performance has been driven by good regulation and strong economic forces of supply and demand. And we see that, those forces are going to continue with the increasing scarcity and rising demand from users who have a greater capacity to pay. And it really is a true alternative investment with a return profile that, it's pretty much uncorrelated to any other investment asset class that you can think of. Obviously we've got these two strategies open and we'd be happy to talk to anybody about either of those in a lot more detail. So that pretty much wraps up the formal content that I wanted to get across. And so I'll hand over to you, Kate, in terms of Q&A.
Great, thanks, Ewan. So for those of you who didn't see me at the beginning, surprise, Kate Westfall with Global Ag Investing. We're really glad you're here. Excellent presentation, Ewan. Thank you for giving it. You may want to stop sharing your screen because we can see everything you're doing now if you're out of presentation mode. But that's fine. If you want to stop sharing, then it'll just be the two of us on the screen, which I think would be very welcome. Georgia Watson from Macquarie had sent in some questions via email, and she woke up early for us, so I want to make sure that we got to them. I do think that they were covered largely in the presentation. So Georgia, if I'm wrong about that, please say so in the Q&A chat, and I will come back to your questions. This was an interesting question that we got from the original chart with the long-term trends. The question is there a chance that the stats that were gathered for the long-term average is not as reliable as the ones gathered in the last 30 years?
That is a really good question, actually.
Yeah, I thought so.
The truth is that the measurement of water inflows, particularly that one in relation to the Murray, has been going on in a pretty accurate way for a long time. There have been water measuring stations on these tributaries into that river that have been reporting back into the relevant authorities over, all the way back to 1892. Now, I can't vouch for the accuracy of them back in 1892, but I think they do give a really pretty good and reasonable representation of what's been going on. They're pretty diligent about the way they did their work,
Okay, very good. Then we have another question from John, wants to know the impact of the concentration in capital investment on sustainable water price and elastic pricing for opportunity agriculture such as grazing or cropping.
Well, I thought that sort of goes back to that chart that I had in there about the sort of gross margin per megalitre of the various enterprises. And it's a shift that I guess happens in other markets as well, where if you looked at farmlands on the outskirts of cities, they've been outpriced by other land uses as the urban fringes expanded. What we're seeing in the water markets is as the expansion of these other industries that can afford to pay more, they do expand, then they actually, because it's a capped amount of water, and in fact it's shrinking, there's less water available for those other crops. And that's really what we're seeing driving the contraction in dairy at the moment. It's driving a contraction in those other, annual cropping endeavours because they're being priced out of the market. It's that's what's happening.
Okay. Can you please discuss how sophisticated the forward water market is? For example, how far out can one sell the water forward? Are there good options markets for water?
Yeah. We have put forward products into the market, but it isn't a sophisticated market. It's all over the counter, negotiated individually between a vendor and a purchaser. And it's really about how much risk that vendor wants to take on in terms of how far out forwards can be written. The longest I've seen have been 3 years. I don't know that there would be too many forwards out 3 years at the moment. And it's a difficult space to operate in. The risks are sort of asymmetric because, as a forward seller, you can only ever get the price that you've sold it for, but you're exposed to potentially unlimited risk if there's a really acute shortage in the future and the allocation price goes sky high. It's sort of uncapped as to how high it could get if you need to buy the allocation to service your forward commitment. So for those reasons, it's quite difficult to price forwards out very far. We know there's probably a lot of appetite amongst irrigators for an options product. It would be a really great insurance product to be able to put a call option on allocation into the future. But again, it's really quite difficult and risky to price that. And so we haven't seen much of an emergence of options either today.
You spoke a lot about the impact fund. There's a specific question to water sustainability and irrigation practices, asking if you account for sustainable irrigation, meaning that does not deplete environmental flows and groundwater depletion.
Not quite sure I understand the question. I mean, there's certainly there's questions around some of the science behind the way that targets have been set for recovery of the water for the Basin, and conjecture around how, there's been money spent on improving the efficiency of water delivery infrastructure and the efficiency of water use on farms. But one of the arguments is that those less efficient water delivery infrastructures actually were recharging groundwater. And now we've lined the channels so it doesn't seep into the groundwater. And that actually, so it isn't getting all of the environmental impact that, may have been intended. I mean, I'm just really not, I'm not an authority on that. But there's certainly a lot of conjecture around it.
I think it goes along. This is another question from the same attendee. Do you consider climate change and future water availability in your investment decisions? Again, just trying to get at.
Well, absolutely.
Do you take
no,
those
absolutely,
things into account?
we do. I think that this is a bit of a tangent, but we have a fund in the space at the moment, which is a land and water aggregation play, where we're focusing on annual cropping. And the reason that we're doing that is because we see some risks building up in this system, as one of those charts pointed out, where we can see perennial croppers needing more water than will be available in the system in some really dry years going forward. And we think that that's going to cause some big problems. And we think that, growing high value annual crops has a lot of merit in this space because it does give you that optionality. So that's an example of how we're sort of factoring in climate change, because we can see that water availability is going to be going down into the future, and that optionality will be really important, so that you're not going to risk losing that capital investment in a perennial crop.
Mm-hmm. I have a couple of people asking specific questions about the fund structure. Do you mind delving into that a little bit?
No, that's fine.
Okay. I have one person asking about fees, which maybe you could take offline. But how do the returns of the two funds compare over similar time periods between your regular water fund and the impact fund, I guess?
Well, they're sort of within a percentage point or two over those periods. Actually, the impact fund has done a little better. It's a bit unexpected, but it's really been about portfolio construction. And it's just had a little bit higher weighting to some classes of water entitlement that have been appreciated more strongly. That weighting is actually towards entitlement classes in the districts that have seen the greatest expansion in these perennial crops, and hence has had the greatest lift in capital value. But other than that, they're really quite similar.
I'm going to sort of combine two questions here. What level of regulatory or legislative risk do you foresee as prices rise and political opinion around eternal water investors, as they've been described here, shift?
Eternal. I mean, it's a question we always get, and it's been, right from the outset. I think that what's really interesting in this space is that right since the National Water Initiative back in 1993, there's been a commitment at all levels to protect the property rights associated with these assets, so that people can have security to invest in them and the agriculture that they support. And that's been evidenced by the way they've gone about doing things, like, for example, implementation of the Murray-Darling Basin plan. They could have just recovered the water by reducing the reliability of the entitlements on issue and saying, all right, we'll just take that away and appropriate over here for the environment. But they didn't. They've spent $10 billion going into the market and buying entitlements and doing capital works to improve efficiency and recover water in that way. And these days, the government is the largest owner. And the other thing I'd sort of make comment in relation to, potentially, regulatory intervention is the sort of law of unintended consequences. The chart I showed earlier, 67% of all these assets owned by farmers, and all of those farmers, in the main, just about without exception, would use those water entitlements as security for their borrowings. And So if you have a situation where, the government steps in and, fundamentally changes the value of these assets, then that will have profound consequences for all of those farmers and their debt covenants with their borrowers, with their lenders. So by creating the market and establishing this asset as something that you can invest in and trade, they've sort of let the genie out of the bottle. It's very difficult for them to then try and put it back in because it'd just be such, widespread consequences. So we don't really think that there will be significant regulatory intervention. There's tinkering like there is in any property market, to try and improve it and make it work better. We've got work coming out that's been undertaken by the ACCC, the Australian Consumer and Competition Watchdog. They have a draft report in May this year on how the market's working and whether it's working efficiently or not. And I think that there will be some positive things probably come out of that in terms of improving the efficiency and transparency of the market. But that's the direction that we expect it to head in.
Okay. There's a question on your views on any competition regulation of water trading that may adversely impact the strategy. Some in the market think financial investors are driving up prices for farmers. I think you touched on that a little bit, but can you maybe circle back on that for a little more clarity?
Yeah. Well, I think that there has been media coverage and concern about, what's going on in the market, mainly because of the significant increase in allocation prices that has occurred over recent years. As those charts I've just, went through outlined. And that's caused significant concern and angst amongst irrigators who have been priced out of the market. From our perspective, those movements are really explainable by the characteristics of supply and demand. But, in response to the concerns that have been raised by irrigators, work has been undertaken both at the state level. There's been a transparency review undertaken in Victoria. It's looked at what could be done to improve market information. That was undertaken last year. And the ACCC, as I just mentioned, are conducting a review on efficiency of the market. I think that what's likely to happen in that space is it will just address those transparency issues, that there'll be more information provided. I just don't see likely changes that would significantly impact on the capacity to invest in the way that we have in these markets.
Okay. We have on the line Angela De Duoni, who wrote Defining the Investment Value of Water Entitlement, asking, given the increasing infrastructure and hydrological constraints in the water delivery systems in the southern connected Murray-Darling Basin, how important will delivery rights be to manage the risk of delivery of water to irrigators to whom the water is being leased?
Mm. Well, that's a hot topic. I think that it's something that perhaps hasn't been considered well enough by some of the developers of these large-scale horticultural plantings in the Lower Murray. You can think of the river as a pipe. It has a capacity. There's only so much water that you can push down it. And some of those crops, particularly like almonds, have really peaky demands in the middle of summer, needing a lot of water over a short period of time. And the regulators have flagged the fact that they really do anticipate that there are going to be some problems in the future. They could really be problems getting water to these farmers when they need it. And there are various suggestions out there in relation to how that could be dealt with, and whether it could be dealt with in relation to having a market for accessing the delivery capability in the system. And, that's a proposal. One of the responses has been in Victoria to actually issue a moratorium on any further development in that part of the world by restricting the issuing of any new water use licences. That said, there are already a number of undeveloped water use licenses out there. So there's still a lot of expansion that can happen, and that is only in Victoria. Such moratoriums haven't yet been announced by South Australia or New South Wales. So look, we absolutely think it's going to be a pressing issue going forward. And again, it's one of the reasons why in our sort of land and water development strategy, we're not operating in that part of the world where we're targeting country which is closer to the dams and won't face any of those water delivery infrastructure issues. Yeah, so it's a looming challenge. There's no doubt about
it. Here's a question. This is back on the impact fund. And maybe you can just provide a little more clarity here. I'm not sure that I got it either. If only 10% of the fund's water is going to the environment in dry times, what is the effect on fish flows? It seems like the fund's supplying more water to the environment when there is plenty in the river and more is being taken out when it is more needed. And then an addendum to that is another question. Can you explain more the role of the Nature Conservancy in the fund?
Okay. Yeah, it's a bit counterintuitive. And we don't say the fund is anyway a replacement for what is the Basin Plan and a countrywide requirement and need to protect the environmental assets in this part of the world by ensuring that there is sufficient water in rivers to avoid things like the fish kills that we've witnessed over the last sort of 24 months or so. What we're saying is that, the fund can play, a small but an important role in protecting some endangered wetlands. And the key point in relation to protecting those wetlands is the fact that they really suffer if they don't get water when it's wet. They're evolved to deal with periods of extreme wet and extreme dry. That's just the way the Australian continent is. But what's tended to happen as we've developed the irrigation, the dams and the infrastructure and the levee banks and so forth, is that water doesn't get overbanked. We don't get overbanked flows anymore. We don't get floods because the water gets captured in the dams. And even when there is big rain events, we've built levee banks so that the water stays in the river. But these wetlands are obviously all adjacent to the major river systems. So what the fund does, it says, well, look, in times when it's wet, that's when we can provide most water to these wetlands and ensure that they do get a drink and that they are able to flourish. But in times when it's dry, well, they wouldn't have been getting water then anyway, and we make the biggest proportion of the water available to farmers. So it's basically aligning the fact that we give more water to the environment when it needs it most and the opportunity costs low, more water to farmers when the opportunity cost would be higher. That's how that works. And in terms of the role that the Nature Conservancy plays, they were a foundation partner in establishing this. They were also a foundation investor. They are the owner of the trustee company that looks after the trust that we make the water donations to. And that trust is charged with optimising the environmental outcomes that are achieved with the water that we donate. So they actually outsource the delivery. They have a delivery partner that undertakes the watering events, but they engage with them in the preparation of annual plans, and they do all of the scientific monitoring and reporting of these events. So, in summary, they're charged with optimising the environmental outcomes with the resources that we give them.
Brief correction to the record. Eternal water investors from before should have read external water investors. The asker wanted us to know that. So I just want to correct the recording. That's external water investors, not eternal. Okay, my friend Lee Adams is here, and he says, I've heard some recent permanent crop investors in Australia have been really beat up by not accounting for these spikes in water costs. Is the presence of your funds considered a stabilizing influence in the market? That is there less of a role for speculation than there has been in other markets?
Well, certainly speculation hasn't been the way we've gone about investing in this marketplace. And he's right. I think that there have been a number of investors, particularly into those permanent crops, who've found it to their surprise that they're, paying a lot more for water than they expected to. I think that a lot of perennial crops have gone in with an understanding that if you look at that chart again, I go back to gross margin per megalitre that they could generate. I think, well, we can outcompete other people in the market because we've got a higher gross margin than all these other people. And if you look at what the average allocation price had been, let's say up until 2015, you look back 10 years, you'd say, well, the average allocation price is $100, $150. We can afford that. We don't need to load up our financial model with going out and buying a heap of water entitlement up front. That does nasty things to our IRR. We won't bother doing that. We'll just go and plant the almonds and we'll step into the allocation market and we'll source our water that way. But what they've found is that when water gets scarce, they're competing in that allocation market with a lot of other people who've thought exactly the same way. And they're facing, significantly higher prices. So earlier this year, they were facing prices of sort of getting close to $1,000, certainly over $800 a megalitre. And that has really hurt them. So in terms of playing a stabilising influence, we do think that we're able to do that because essentially what we're doing is providing an alternative source of water to those types of farmers. By buying water entitlement and leasing it to them, that means that they're not having to use their balance sheet, but they're securing their ongoing access to the entitlement, and so they're not necessarily in the allocation market and causing those spikes in price.
Okay. Are you subject to any competition in water sales to your off-takers? That's a question. I'm not sure. I
mean, there are other people doing what we do, and we find, if I looked across all of the water that we manage in, water-only investment strategies, it's about 70 to 80% leased. And we often do bump into our competitors who are, offering lease products to the clients that we are wanting to work with as a counterparty. So, there's competition in the space for sure.
Yeah.
And this sort of spot allocation market, well, you don't know. And obviously, there's all sorts of people selling water in that space. It's farmers in the main, but also, other investor competitors in the market too.
Mm-hmm. Like any business.
Yeah.
How is the capital value of the water determined, and how does this flow into unit pricing in the fund?
Mm-hmm. So we engage with an external valuer who, steps into the market or looks at the market every month. There's a lot of evidence. There's water registers. So those registers record all of the transactions and they're publicly available. There's some... one of the problems with the registers is that there's a time delay. So if you were to contract to sell your water entitlement today, it's probably going to be 6 to 9 weeks before that gets registered, just through the process that you have to go through. Pretty much like a buying and selling real estate. You don't settle instantly, you settle down the track. So our valuers look both at what's going on in the register as well as consulting with all of the brokers. There's a lot of brokers that operate in these markets, and they publish on their websites and the transactions that they have facilitated. So they collect up all of this data and provide us with a monthly valuation report that can get applied to all of the portfolios that we manage. And then those revalued portfolios go into the determination of unit price.
Okay. This has come up many times over the past decade or so about whether the situation in Australia with water rights could ever be replicated outside. I know that a lot of North American investors have talked about trying to create a water market here. Do you see a future for this type of strategy outside of Australia?
That's a good question. We've had a look in the US, and it was one of the reasons I gave the history to start with, because one of the things that's sort of unique here is the way it all came about. Basically the state built all of the infrastructure and then privatised it. Whereas my understanding as to the way in the main things are developed in the US is it's really been an evolution of like the settler laws. Like, you settle a farm here, you've got access to the river, you know, you take your water right, and whatever's left over is the person down the river, and so it hasn't been developed in this sort of structured way. From what I understand, it'd be very difficult to change things like in the US, because there would necessarily be winners and losers, and the losers wouldn't be happy about it at all. So, you know, that would make it quite difficult. There's certainly been quite a lot of interaction between, you know, regulators here and in other parts of the world, like particularly China. They were keen to try and, you know, see what they could do there in terms of emulating what's happened in Australia. And we understand that there are some markets that have developed in places like Chile. They tend to be smaller though, because you've got a lot of sort of short rivers running out of the Andes and out to the Pacific. And so there's some trading up and down the rivers, but you don't have something like the Southern Basin where you've got a huge geographic area that you can trade across because all the rivers run into one. Look, we haven't seen any markets at the moment that look like the market that we've invested in.
Yeah, that seems true. When acquiring new entitlements, how do you model the fair value?
Well,
it's kind of a rough one to sort of close out on, but maybe you can.
Well, Caitlin and I have been developing our valuation model since about 2012. It's gone through I don't know how many iterations. It's a complicated beast. Essentially, what you need to do is, you know, that's where that allocation price curve comes from. You know, you look at what the allocation price is going to be in any given year based on supply, but how do you know what the supply is going to be into the future? So, you know, you run all sorts of, you know, modelling that has, you know, multiple scenarios so that you can, you know, think about what happens under, well, you know, a continuation of this trend or a different trend. Yeah, but that's essentially it. You look into the future and you sort of think about what's going on in terms of average allocation price. Average allocation price is going to be determined by water availability. So what's going to happen with water availability, model that, price, capitalize it or DCF it. That's, you know, that's what you do. And think about other factors and features of different entitlement classes that enable them to be distinguished. Things like their capacity, you know, to have greater or lesser capacity in the system to trade with other zones. Features like whether they support carryover or whether they don't gets built into the model. Yeah. We've spent a lot of time on this.
Yeah, I bet that's the case. A lot of people are asking, and I should have asked you this before, I suppose, but I'll put you on the spot now, if we're going to make your slides available for them to download.
Yeah, sure.
Okay, fantastic.
We'll put them on our website too, so you can get them there at kilterrural.com.
Very well done. Way to stick in the website there. I do encourage you all to head over to kilterrural.com. And after you've been there for a while, head back over to globalaginvesting.com/webinars to see what other great content we have coming up for you. We hope to see you soon and in real life. But until then, we look forward to seeing you again here. Okay, have a great day, everyone.
Thanks, Kate.
Thank you,
Thanks,
Ewan.
everybody. Bye.